Gold hitting a record high this morning, touching $2,100, but since pulling back. But is another rally on the horizon as geopolitical uncertainty continues and investors bet on future rate cuts? Mike McGlone, Bloomberg Intelligence Senior Macro Strategist, joins us now. Good morning. Thank you for joining us. So for people who are trying to get a handle on the correlation between what we've seen with gold prices historically and the S&P 500 here, what does that lay out about the path ahead recession-wise?
Gold up, S&P 500 down, I think is a potential trajectory for next year. The key thing right now is gold's just kind of frustrating to most people, made a new high. And then we, basically last night at $2,135 an ounce. And now it's just trying to see if it can hold that support around $2,000 an ounce. That used to be resistance. I think it will. But I think you mentioned the key factor is if the stock market keeps going up and U.S. interest rates stay high, and there's not a lot of reason for gold, but I think that's all transitioning. Now, one of the things today is the market's price for a lot of Feds next year, Fed fund futures, so almost 100 basis points by this time next year, which might be more an issue for the stock market. But the way I see gold is the deepest pockets on the planet are buying gold. That's central banks. Now, ETFs haven't really been much buyers, but I think gold is in the early days of a bull market breaking out to new highs and just frustrating some people by not continuing.
Mike, we often sort of simplify the gold trade by talking about it being a safe haven. What's different about this rally that we have seen? It certainly feels like it's got more legs to run.
Well, what's different specifically today is there's the digital alternative. I'm not surprised gold's knocking around and driving people crazy around $2,000 an ounce. It's been doing that for 3 years. But it's the fact that despite the stock market being down, digital gold, Bitcoin is up a lot today. So I think it sticks with my narrative that this is not our father's gold market. You really can't hold gold anymore or have interest in gold without some Bitcoin in that space because it's better fit for the world going digital. So I'm bullish gold. I'm less bullish Bitcoin if the stock market goes down, but it's proving divergent strength. So to me, that's the key thing that's different is that there's that alternative in digital gold.
And so, Mike, how would you compare gold versus other commodities that you have your eye on heading into 2024?
A good assessment. It's a significant recessionary trajectory. So virtually all commodities going down, industrial metals 15% or so, energy commodities down almost 20%, grains down almost 20%, and gold going a clear recessionary trajectory from commodities. The key question is, does something stop it or does it accelerate next year? In my bias, it's going to accelerate. We have issues. We see what's happening in China, potentially recession already in Europe, U.S. tilting towards recession. We look at leading economic indicators and Bloomberg Intelligence. Yet it was only a few months ago, most central banks were still tightening. So to me, that's the recessionary trajectory for maybe from more of an adult, less speculative market, which might be industrial metals. Versus the U.S. stock market, this might be going up on hopium and for cuts, federal rate cuts, which Fed has told us, the chair policy is they're not going to be cutting rates anytime soon, at least not in, I think, the way the market's expecting them to.
So we're looking at spot prices right now, Mike, off of that $2,100 high that we saw. How much further do you think it goes? Or how much higher do you think it goes?
I think gold's going to be heading towards 3,000. It's a question of when. I think it looks to me very similar like it did when it leaped and had that issue of 2008. It bumped up against 1,000. It dropped around 700, and then it leaped at 1,900. I think it's doing something similar. So to me, the key thing right now is how can it hold support around 2,000? That's kind of the new support transitioning from old resistance. And right now, it's just frustrating the most. But I fully expect it to head towards 3,000 and maybe even next year. But remember, the deepest pockets on the planet are buying central banks. They still are. ETF buyers might flip, but I think it's going to take higher prices for what's been selling at ETFs, which is very rare, for them to start flipping towards positive in gold.
So, Mike, for people who are new to perhaps investing in gold, not sure how it fits into a portfolio, how should they be thinking about it as an investment?
Well, it's easy to invest in gold through ETFs now. I think you look at gold as the base layer of money on the planet. So if you look at like the S&P 500 and divide by gold, I think it's about the same as 1997. If you compare it to land prices, It's a very stable measure. It's not affected by the massive pump in liquidity we basically saw from 2000 to 2022. So I look at gold as that's a stable measure. And the key thing that's happening right now is that if you look at the price of gold since we came off the gold standard in 1981, it's the per ounce price has basically fluctuated between above the S&P 500 and well below the S&P 500. And every time it's been at a significant, the level of the S&P 500, the per ounce price of gold, and we have a recession, gold just kind of catches up. So that's why I'm using that 3,000 level. Gold just typically catches up. So you look at equities, historically a little expensive, and gold historically a little cheap versus S&P 500, particularly for a U.S. recession.
Gold prices rising for the fourth straight session, hitting a 6-month high. Jared Blanke here with a look at what is driving those gains. Hey, Jared.
Hey, Julie, we've been here with the price of gold a few times before. Is this going to be the breakout? Right here, I have a chart going back to earlier this year of gold with the inverse of the 10-year real yield. So this is showing how bonds, at least the inverse of the real yield, were correlated. And then we had the Gaza incursion. Gold kind of decoupled and it hasn't looked back. Interesting to note another correlation, which is gold with the US dollar. Here I have as a proxy gold versus a euro. Why? Because a euro is moves inversely to the dollar. So when this is going up, the dollar is actually going down. And what we see is gold has been moving almost in lockstep, at least directionally, with the inverse of the dollar. And with all the talk about the Fed potentially being on hold, that has given the dollar's rise a pause. In fact, it's been sinking during the month of November, and that has been a tailwind for stocks. Also, I'd note that big drop-off in rates, that has also been supporting the case for gold because gold does compete for other things in terms of interest rates. Let's go to our futures heat map, and I'll just chart the raw price of gold. This heat map shows all our commodities over the last 2 months, and gold here is on the top line, up 10%. Now, let me just put a 5-year chart. I said gold has been here before. Well, that's because it's been above $2,000 an ounce 4 different times. 1, 2, and it's hard to see here, but 3, 4, 1 month apart. And it looks like now finally on the move to break out. And if we did have the dollar, I guess, agreeing with it by backing off and continuing to stay on its downward course along with rates, that would support the case for higher gold just on a technical basis. And given the length of the consolidation here, we're talking more than 3 years, we could easily see a big pop to the upside. But is this going to be the time, or is it going to be 1 month from now? That's the trick with some of these long-term charts. The timing gets a little bit difficult, but nevertheless, the setup is here.
Gold prices in focus. They traded in both directions after this morning's inflation data, with U.S. futures holding around $19.50 per ounce. What does the latest CPI print mean for gold? We want to head over to Jared Blanke, who has a closer look at some of the action that we're seeing right now. Jared.
Yeah, so no inflation. You would think, well, gold's in inflation head, might be going down. It did go down just right when the report hit, but that was one of those low liquidity spikes looking for GC equals F. There we go right there. And this is a line chart. You can see on a candlestick, let's see a 2-day chart here, how it dipped below, but then it quickly recovered. And you can see we're actually holding around 1962 right now. Now, in a longer term view, we have been flirting with the 2000 level, put a line chart right back, for some time. 2050 is really the breakout level. I was talking to Ms. Schneider a few weeks ago on this program. She's looking for 3,000, but you got to clear 2050 first, and there's a lot going on here. I just want to get back to some of the largest marginal purchasers of gold, besides the retail public, is central banks. Now, this is a chart, I was showing this last week, goes back to 2010. This year, we are only through Q3. That's as of the third quarter of this year, so we could easily top last year's record. Interesting to think who's doing that. It's China, it's Russia. They have been de-dollarizing for some time. And then I want to talk about the interest rate structure. We saw a huge drop in the 10-year T-note. We'll see if I have time to get to that in a second. But over the long term, gold has really come unhinged from the bond market. This chart goes back 20 years. Here's gold prices in cyan. Here's the inverse tips rate. Not going to get into the wonky bond stuff just now, but suffice to say this morning is going in the right direction. It would close this gap from the yield perspective.
Well, gold is up fractionally today, but it's been under pressure recently after a brief stint above $2,000 an ounce. Central banks have been some of the largest buyers of gold bullion, which is up 14% year to date, according to Bloomberg Intelligence. And for the average investor, Morgan Stanley is saying it's a good time to buy gold stocks. Yahoo Finance's Jared Blickery, he's got all the details here for us. Hey, Jared.
Hey, Brad, let's go to the Wi-Fi Interactive, where I am looking at gold futures right now. As you said, up fractionally today, but under a little bit of pressure over the last few sessions. Now, this is a 2-month chart, and beginning with the Israeli-Hamas incursion war, that fueled a rise to about $2,000 per ounce. And this has been a ceiling historically. I'm going to show you a 5-year chart now, and you can see how gold has bumped up against this. This was the first record high, and then we got another attempt here and a third one where we exceeded it by just a tiny little bit. And now we are still in the upper end of that range. However, when we're in a trading range, we have to be careful because it's quite easy to return to the bottom. And I would also note that there was a really nice fake out here in 2022 for gold bears that did not work out for them. Now, I also want to show you some of the largest marginal buyers of gold, not people, but central banks. This goes back to 2010 and shows you how many tons central banks are buying here. And you can see 2022 last year was a record year. We have China buying gold. We have Russia de-dollarizing, which is about a 10-year-old trend. And I should add that this candle right here, or this bar right here, is only through Q3. So we could easily see this exceed last year's high. And if that happens, it might be concomitant with a price rise to $3,000 an ounce. And that's something that people have really been looking out for. One hiccup, this is a major divergence. This is a 20-year chart of gold, which is cyan, and you can see that it's right up there by about $1,900, $2,000 an ounce. And then an inverse chart of the U.S. 10-year tips yield. So without getting into all the wonky bond stuff, all I want people to realize is that there is a huge gap here. And since this is the inverse, we could see interest rates fall or gold fall to meet each other in the middle. We'll have to see how that resolves. But as I said, or as you said in the beginning, Morgan Stanley recommending gold stocks. I was checking with Bloomberg Intelligence. They believe that there's a $150 premium on gold because of the Hamas-Israeli incursion. That could disappear if things go away. It could increase if things get better. But nevertheless, that's where the numbers stand. So here we are. I was interviewing Mish Schneider a couple of weeks ago, and she said if gold finally punches through 2050, easily heads to $3,000. So on that note, I'll close the book here on the other Bitcoin, gold.
And while stocks are moving lower, investors are seeking some safety in gold. Prices edging higher. Jared Blickery is on the floor of the New York Stock Exchange with more. Jared.
Hey, Josh, we have had a really impressive run-up in gold over the last couple weeks. Let's go to the Wi-Fi Interactive. I'm actually showing gold versus bonds because something really interesting has happened. They have diverged very recently. Now, these two asset classes don't track each other tick for tick, but they do generally go in the same direction, and you want to pay attention when they diverge. So you can see on the interactive how we're tracing out the very similar paths until recently. Bonds sold off a lot more, and this is inverse to yields, by the way. And only within the past few days, we have had a divergence, and that is with gold trading up and with bonds also continuing to trade down. Now, I want to take a longer term look at gold and just kind of paint some different scenarios. When gold rises, it can be from different effects. We say that gold is an inflation hedge. It's also an Armageddon hedge. But usually when gold doesn't track what's happening in the bond market, we have to look and see what could possibly be going on, because we've had a number of good rallies in gold over the last few years. Those were confirmed by the bond market, but you'd have to go back to, say, 2006 to 2009 to find an episode where they were diverging like this again. And we are seeing that. I was talking with Macro Alf, that's Alfonso Picatiello of the Macro Compass, about this, and he's saying that the run-up that we're seeing is very similar to what happened in 2007, actually 2006 to 2007. That's when the Federal Reserve went on pause. Interesting to say that we did get a rally in stocks, we did get a rally in gold, but of course the deflationary forces in 2008 took over. First we had Bear Stearns. Actually before that we had SocGen. Jerome Carville blew up a hedge fund at SocGen. Then we had Bear Stearns, and then we had Lehman Brothers. All of those deflationary forces were then countered by QE and massive expansion of the Fed balance sheet, and that's when we got this big rise up here. So what's happening with gold right now? Difficult to say. One interesting theory is that central banks are dumping their dollar holdings to buy gold. That could be China, it could be Russia. Russia's already done quite a bit of that in the past, and to be fair, China has too. But there are evidence in the swap market that that is one of the things that could possibly be happening.
Investors are responding to the threat of escalation in the Israel-Hamas conflict, sending oil and gold prices surging. The market is pricing in the worsening of the war in the world's top oil-producing region and retreating to quote-unquote safe haven assets. For more on this, we've got Yahoo Finance's reporter Jared Blickery standing by with a little bit more insights and in-depth analysis. Hey, Jared.
Now, I want to show you what's happening with gold futures as well. This is a max chart. Now, in 2008, during that deflationary crunch that we saw a little bit of a downtick in gold, but not much. And it was actually during the QE era that we saw gold finally rise. Looks like I've lost my connection again, so I'll just close by saying that we've seen a lot of pressure on commodities, but it's not even close to the scale that we saw in 2022, the beginning of the year with the Ukraine-Russia situation. So it leaves me to believe that we probably have a lot more potential upside to go should things worsen. And also, as the Federal Reserve, I guess the battle between the Federal Reserve and interest rates and inflation heats up, there's also that dynamic as well. So the bottom line is commodities have really only started to take off, and it doesn't mean that they have to go up in a straight line, but thinking out to the end of this cycle and the beginning of the next one, that's where we see those pressures probably coming into play.
JP Morgan's chief global markets strategist Marko Kolanovic is all in on safe haven investments as tensions in the Middle East heat up. Now, in a note to clients, Kolanovic reiterated that he is underweight equities and recommended buying bonds and gold, saying, quote, while it remains uncertain whether bonds have bottomed, we add back 1% to our government bond allocation, given geopolitical risk, cheap valuations, and less pronounced positioning. So not necessarily anything new that we're hearing from Marko Kolanovic, but again, just a warning here to the street just in terms of what exactly the next couple of months could look like when we talk about the pressure that we could potentially see on equities. We've seen many strategists here rein in some of their year-end price targets for the S&P, what that looks like going into 2024 and how this all plays out. Obviously, a huge issue for investors, and we're seeing that reflected from some of these analyst calls on the street. Investors on edge today as a strong ADP report suggesting more rate hikes could be on the table. We're back with Frances Newton Stacy from Optimal Capital. Go through some of the stocks that she believes are the best bets right now. Stacy, let's start off with gold. We're not too far from those record highs where we were just about a month ago. Why do you think it's still a very good hedge at this point?
Okay, it's selling off for sure because we've had this rise in tech. But I do think that as the credit risks increase, as we go further with rate hikes and we get further away from our first rate hike and the lagging effects of the rate hikes come in, I still think that, that affects real rates, and real rates affects the price of gold. You start to have a correlation between the dollar and a positive correlation between the dollar and gold. And I do think, again, there is credit risk in the market, so I would be buying the dip in gold because the other things that have taken off this year are, don't want to chase those trades.
Yeah, gold's one of those where if you go back and look at the analogs of 2011, when we had the debt ceiling debate, post that we had equity markets sell off. We also saw a bid, gold caught a bid. We believe we could see a lot of that playing out. Equity markets are obviously just trading flat right now the last couple of days as we get closer to the debt ceiling. And I think post debt ceiling, whatever happens, equity markets will then trade ultimately maybe negatively on the news. So therefore, gold, add some gold in your portfolio. We believe it's under-owned and it's a great diversifier, especially in an inflationary environment, and it actually does perform very well over the long term.
Well, 2023 has been a year of rebounds for some beaten down assets. Bitcoin perhaps the most notable, but with inflation, rising interest rates, and the growing fear of the US defaulting on its debt, is the tide about to turn? A great time to speak with Mike McGlone, Bloomberg Intelligence senior macro strategist. Good to have you on the show here. So we mentioned Bitcoin, one of the best performing asset classes by return year to date, along with gold. So you have your traditional safe haven and something that at one point was considered digital gold or a digital safe haven. Break those down for us, starting with Bitcoin.
Well, Rachel, I think it's important to note that virtually all risk assets have been up this year. Bitcoin is one of the riskiest, and some people call it the fastest horse in the race. It's up the most, but it looks like it ran into a wall resistance around 30,000. It looks like risks are tilted now towards the downside, particularly if the stock market starts rolling over. Yet gold's the opposite. Amongst commodities, it's the significant major commodity that's up on the year on a 12-month basis. It's up about 10%. And you look at the Bloomberg Commodity Index on a 12-month basis, it's down 24%. But I think what you're seeing happen is deflation in commodities, most particularly fossil fuels like crude oils, down 40% on a 12-month basis. It's fueling inflation for gold. Yes, we have this budget crisis. But I think the biggest risk now is as we tilt towards recession, that gold continues to outperform most assets and including Bitcoin, unless we get that stock market to take off, and that's kind of counter to what I think the Fed's wanting.
Let's get to the big merger that we are hearing about in the gold space today. Newmont Mining has secured a $19.2 billion deal to acquire its Australian rival, Newcrest Mining. That deal is pending regulatory approval, but it does mark the largest deal ever in the gold mining sector. This is something that's been talked about now for a little bit here. It was public that Newmont was pursuing Newcrest here, and the initial proposal was made back on February 5th. So this is about a 30% premium at this deal price to where it was trading right before that deal was first proposed. In addition to beefing up the gold mining capability for Newmont, this also increases its exposure to copper. Newmont's, the real bulk of its revenue does come from gold, about in the 80 to 90% range. Whereas Newcrest also is very reliant on gold, but has a little bit more of a copper operation too.
Yeah, and within kind of the need or the push for more copper, you think about the areas within even the Inflation Reduction Act that had carved out space for electric vehicles to really get even more of a credit, or not just credits, but even more of the build out and where copper comes into play for so many of those batteries as well. But then also you think about the prices that we had seen of gold. Gold is still, if I remember correctly, hovering or near the ballpark of some of those record highs too. So all of this taking place as you're taking a look at gold futures right now, sitting above $2,000 at this point.
Wow, yeah. With inflation sticking around, a lot of investors are now looking to use gold to try to safeguard their portfolios, or at least hedge against inflation. The precious metal reaching a peak of $2,010 in mid-2020 amid the COVID-driven slowdown. And now the world could be on the cusp of a recession. There's a growing number of investors expecting a breakout in gold prices this year. We've already seen them up quite a bit. Here to discuss is George Milling-Stanley, State Street Global Advisors Chief Gold Strategist. George, it's good to see you. You know, GLD, which of course is the ETF that you help manage, is up about 8.5% this year. We've had sort of concerns about the global economy before, including to some extent last year. What do you think is sort of driving this current push for gold prices to go higher?
I'm not sure there's anything really new here, Julie. We've talked about a lot of the reasons why gold has been at a fairly elevated level for a while. In fact, if you think about it, gold's been flirting with this $2,000 an ounce level for the best part of the past decade. It often takes a long time for a market to make a breakthrough into a new big figure, to move from the 1,000 and something to the $2,000 level. The $2,000 level has been a price at which a lot of people were happy to take profits for the best part of a decade. And that kind of a sentiment can get sort of embedded in the minds of investors. If it was right before, then it's going to be right this time and probably right next time. So I think we've seen a good deal of that lately. But it does seem to me, if there is something new in this equation, it does seem to me that there's definitely upward pressure with the fear of what could happen to the equity market if indeed we do tumble into a significant recession. And that seems to be the way the thinking is moving. The Fed has gone from talking about a soft landing to a soft-ish landing to this is going to cause pain, and they're now actually using the R word in Fed speak. And I think that's probably the new thing that has come into the equation. I think that's probably what's going to provide the impetus for prices to make that decisive break through the $2,000 level.
George, how has gold performed during past recessions?
Very, very well indeed. We've had 7 significant recessions in the last 50 years, which incidentally is the period I've been covering this market. So I've been there for all 7 of those significant recessions. The annual average appreciation in the gold price over all of those 7 recessions has been better than 20%. And remember that that's in a period when we're in recession. That's when equities are in negative territory, when bonds are going nowhere, when most of the other assets that you'd find in a typical portfolio these days are really suffering very badly. So gold in recessions at better than 20% annual returns, I think that's a really stellar performance. And that's the kind of performance that I'm expecting to see if indeed we are going into recession in the US and possibly globally over the next few quarters.
Of course, George, gold, as much as any, if not more than other commodities, trades on this sort of global sentiment. But there's also supply and demand, like with any commodity. And I was just looking through the Newmont mining numbers today, which sort of highlighted as it tries to buy Newcrest to increase its capacity, it sort of highlights some of the supply constraints among the major miners as mining gets more expensive to get more gold out of the ground. Is that something that's sort of underpinning the gold price as well? What do you expect that dynamic to look like?
I'm really not expecting much in the way of change on the supply side of that dynamic that you're talking about, the balance between supply and demand. Basically, mine production goes up 1% or 2% a year, or it goes down 1% or 2% a year. It's not one of the major variables in that equation, the balance between supply and demand. What is interesting is the gold mining companies recently have been spending record amounts on exploration and development, and they're looking at brownfield sites around existing mines. It's always a good place to go exploring, but also greenfield sites where they've never been before. And at this point, they're simply not finding enough new ore bodies, new production in order to maintain production at the current level. And of course, what shareholders are looking for is growth, not sustained production. That's probably why the share prices of the mining companies have been somewhat depressed lately. But I think more interesting and more likely to be helpful for the price is what's happening on the demand side. You'll remember that during COVID, especially during 2020, but continuing into 2021, jewelry, which is more than half of a typical year's consumption, took a very, very serious hit. It dropped down to around a third of total demand instead of being better than half. We're now looking for a recovery. Most of that jewelry goes into the emerging markets. We're seeing a significant recovery in the Chinese economy now that they have finally abandoned the zero COVID policy. And as China's economy goes, so go the rest of the emerging markets in general. So we're looking for a significant rebound in gold jewelry consumption. We'll be seeing numbers from the World Gold Council for the first quarter at the end of next week. So we'll have a better handle on things then. But anecdotally, I'm hearing that jewelry has indeed shown signs of that rebound that we were looking for last year and didn't actually get. We get it this year. That's definitely going to be helpful for the price. On the investment side, and this is the other major component of demand, I'm not seeing any reduction in uncertainty. You mentioned the recession word. I think that is front and center in most investors' minds. Plus, of course, the fact that inflation, while it's wonderful, it's come down from 9% a year to 5%. If you go back 18 months, 5% would have been unacceptably high and impossible to contemplate. So there's no reduction in the anxiety that is fueling investor demand for gold.
George, sounds great for the bling bling trade out there. At the end of the day, too, I got to know, have you developed, a strong thesis on gold in the age of what has been called digital gold? And perhaps this is a much longer conversation. We only got 30 seconds here, but gold versus Bitcoin and how that stacks up.
Yeah, Bitcoin is very, very volatile. There are people who complain about gold as a volatile metal, but since Bitcoin was launched in 2009, its annualized volatility has been around 10 times the level of gold. I think that Bitcoin has identified itself, along with the big drop in assets last year, a drop of 2/3 in value. I think that Bitcoin has identified itself as just another risk asset. Gold still does offer protections against an awful lot of the things that investors are most worried about right now.
Gold seeing a slight pullback after logging its second highest settlement level ever on Thursday. However, the precious metal remains on track for a 7th straight week rise. Here with more on where gold can go is Mike McGlone, Bloomberg Intelligence Senior Macro Strategist. Mike, gold sitting above 2,000 an ounce. Is 2,000 the new support? And is it off to the races from here?
Yes and yes. Thanks for the easy question. I think it is. Pulling back a little today, but I think it's inevitable that gold gets above this $2,000 an ounce level and never looks back. And the key catalyst is the stock market potentially rolling over. And here's a big difference with gold compared to the stock market. I look at gold versus the S&P 500. It's very low on a 121 basis. A 10-year basis is basically unchanged. The stock market total returns around 300% or so. Those are starting to reverse. And the big difference the last time we did this was really around the start of the new millennium, was the Federal Reserve was well into an easing cycle. So I see this as just the catalyst for gold to take off. It's one of the few commodities I'm really bullish on because everything's starting to tilt downward towards deflationary trends.
Yeah, and we definitely have seen investors pouring into gold. Talk to us about what happens if the Fed doesn't pivot this year. I mean, what will happen to gold in that scenario?
Markets will make them. I think that's the stage we are right now. The Fed will pivot when the market makes them, and the number one thing to make them pivot is probably the stock market going down, the S&P 500 dropping at a higher velocity. It's been hovering around this 4,000 level, up or down 200 points from that. And I think it's just inevitable at some point it tilts back down because the Fed's not going to ease, it looks like, until it doesn't. I mean, the jawboning from the Fed governors is quite serious. They keep talking about higher rates, despite the data we've seen all this week. They're starting to get that trend of misses, misses on PPI, misses on retail sales. It's just, to me, part of what happens in a recession. I think that's the stage we're at right now. The markets are getting it. 2-year-note yields, 10-year notes are getting it, but the Fed is still being vigilant against inflation, which is collapsing. You look at PPI, I see PPI and then year-over-year basis heading towards negative by the time we get to July. And that's just what happens normally when commodities collapse.
For people that are just looking at this gold rally, this recent gold rally, and thinking, man, I want to get in on this. I mean, what is the best way? Is it through ETFs? Should they be buying physical gold? What do you say?
Well, that's the thing that ETFs made it so much easier for people like me who used to, I was kind of afraid to buy physical gold before ETFs, so you buy equities. ETFs are such an easy way to do it. It's quite clear. But I think one thing that's going to be coincident with this gold rally is the rally we're having in U.S. long bonds and declining yields. So ETFs are just an easy way to express those views and investments.
And the miners?
Well, it's the history of miners. Miners, you have to be more selective. You can get those many X's of returns, but you have to be selective. The overall miners, like the GDX index, has a history of underperforming gold over time. And the key reason for that is you just can't create more gold cost effectively like you can crude oil and a lot of other commodities. So overall, that physical ETFs that track gold have a history of outperforming indices like the GDX index, which is just an index of miners.
Yeah, gold has actually done very well too. It's picked up, I think, globally about $2 billion so far in recent weeks, which is a lot of money if you think that gold has kind of lagged the whole commodities segment for the last 2-3 years. All of a sudden, it's found its momentum and assets are trickling in big time. But if you look at, portfolio managers and strategists out there, the call is one about risk management. And in that scenario, it's all about the diversification. So you keep your core equity, you keep your core fixed income position there. What do you do on the edges? Gold is standing out as a big opportunity here because it hasn't really gone anywhere. So people see upside in gold more than downside. It's a safety play in a time of uncertainty. It's a hedge for inflation, and people are buying it. So it's been really a phenomenal year for gold so far.
You're looking at gold off a little bit today, pulling back from a 13-month high on weaker economic data. Still, though, obviously above 2,000. Gold since the start of the year up just about 10%, hovering above that critical $2,000 level here and just trading just about $50 below its record high. We want to bring in Bob Iaccino. He's Path Trading Partners co-founder and chief market strategist. Bob, it's good to see you here. So we're holding above that 2,000 level. I think a lot of investors are asking if there's really upside here to the price of gold. What do you think?
I think there is. Gold was my big call for the year. I'm sticking with that as of this point. I still think we're going into recession, although the timeline may be pushed a little bit. The yield curve says we're already there. Economic data has kind of started to slow. And if you're long gold, which I am, the best case scenario is the Fed cuts rates to get you out of a recession, which is positive for gold. Worst case scenario, the Fed continues to raise rates. I think this is the least likely. And they hold the pause a little bit longer. 2 out of 3 of these cases is good for gold. The worst case scenario is that they hold the pause and we actually get this soft landing or easy landing or even no landing. That wouldn't be great for gold, and I think that's the least likely scenario.
Fed certainly plays a role. Bob, talk about some of the other factors driving the prices where they are today.
Well, again, you have this issue of asset prices being sold off, and gold has always taken advantage of that. And what's generally happened is the Fed, again, bringing that out, cuts rates to help the economy and help asset prices. That's been a driver of gold in the past, and a lot of people believe that. CME Fed Watch Tool has cuts starting in July of this year, which the Fed says they're not going to do. Another one is people think of gold as an inflation hedge, and it's really not. What gold is it's an asset. And if you look at assets in general, when inflation starts and then continues to rise through, gold powers through that because it's an asset. Just like house prices, just like stocks, we forget the good part about inflation is asset inflation, and gold is an asset. The problem comes in for gold investors when the Fed starts to aggressively fight inflation. So something we haven't had, which has contributed to gold's underperformance over the last decade or so, was we haven't had inflation, so we haven't had a Fed to fight inflation. And that's kind of gave gold this weakness. When inflation started, gold rallied. We saw that March spike that references almost the all-time high that Shauna mentioned. We're driving toward that again. And if we are in a situation where, as Neil Dutta from Renaissance or at Macro put it, inflation remains unaddressed, then gold's going to benefit from that.
Bob, how much upside is there to gold? Are we talking 2,500? Are we talking above that?
But here's what people think I'm nuts. I think we can easily break to new highs. And I think if it goes the way I think it's going to go, easily within the next 12 months, we could see 2,800. I used to say by the end of the year, I'm not saying that anymore because I think the Fed was much more aggressive than I thought they would be when I made that call. But I think the issue here is the popular opinion, and the politically popular opinion is that the Fed should stop trying to fight inflation. And I don't think people realize how bad that is for the whole country as opposed to just 2 or 3 million people. And I don't mean to downplay that. I want to stress that. But the 2 or 3 million people that may lose their jobs in a recession, as investors should look at it, is good for gold. Is good for stocks. It's not necessarily good for gold. Where gold outperforms is when there's inflation and a recession. And I think that's what we're going to, because I think the Fed is going to cave into pressure and stop fighting inflation.
The gold buds are really loving this moment with gold above the $2,000 an ounce level, inching towards a record high. It could be a series of days before this happens. Look, the JOLTS report sent gold higher today. It has flirted with this $2,000 level, but up until now, not closing on it yesterday. It did close at a 2023 high. Traders are basically betting that the Fed is going to have to pivot to perhaps cut rates later this year. And gold tends to do well under this scenario. When the markets believe that the Fed is pivoting or the tightening cycle is just about over, when the 10-year Treasury yield is lower, as we have seen it, and also when the U.S. dollar is lower, as we have seen it lowering. And so that all helps buoy gold prices. Now, we saw an acceleration also when it came to gold prices in March. This is after the banking crisis. With that banking crisis, we saw investors flock to gold. And in fact, I spoke to one analyst that said most certainly there could have been flows of money that were going from the banks into assets like gold. Bank of America wrote a note saying a new all-time closing high in gold prices would go a long way in signaling significantly larger upside in 2023 to 2025. So that's the idea, that gold would do well this year and going into next year as well.
Gold is often viewed as a safe haven and store of value during times of economic decline, though the commodity often gets a bad reputation due to its stability as return-seeking investors look to riskier assets for higher returns. But as more investors weigh the odds of a U.S. recession and impact of recent bank failures, are we due for a retreat to gold? Here to weigh in, we've got Bloomberg Intelligence Senior Macro Strategist Mike McGlone. Mike, your answer to that question, are we due for some type of retreat to gold or reversion to what has been referred to previously as the boomer rock?
Well, the answer is absolutely yes. We're way overdue for it. If you just look at today, gold has made a new high in the year. At the same time, the U.S. 10-year note yield has made a new low in the year. Those are enduring trajectories that I think are just getting started. The key thing that's pressured gold the last 10 years or so has been the U.S. stock market outperforming the world. You look at the U.S. stock market versus the MSCI ex-U.S. index, it's been taken up. So why touch gold in that environment? Everything's flipping now. The Fed is starting to, in the forward-looking markets, as I mentioned, yields are starting to look for the Fed to pivot, and it looks like gold's just ready to break out. So I think these boomer rocks they're set up for a boom.
And you mentioned the 10-year T-note interest rate, which I would note today looks like it's threatening to break to a 6-month low. How key are interest rates to when we talk about gold and its price appreciation? Because when we are talking about breakaway inflation and laughing at the transitory remarks, gold was suffering, but it came alive last November, and I think that, or October, and that was kind of concomitant with finally a drop in real rates in the 10-year and some of the other brands. Could you just explain the interplay between rates and gold?
I think markets are starting to realize that we are starting out and probably embarking on a significant deflationary period. Crude oil, fossil fuel deflation is actually fueling gold inflation. So I'll give you a good example of that. You look at the price of the benchmark measure in this country of heat, electricity and fertilizer, natural gas, it's dropped to the same price it first started trading in 1990. It's down 80%. So that's a sign of forward-looking markets pricing in for pretty significant deflation kicking in. The Federal Reserve is still tightening. So gold typically does very well in very inflationary environments or very deflationary environments, i.e. recession. So that's where we're tilting now. And I think that's what the scale is. And that's where the trajectory is. The key fact is the Federal Reserve is still tightened despite the fact we have a pretty significant indications to deflation in forward-looking markets like natural gas and crude oil tilting lower. The Bloomberg Commodity Index is down 20% on a one-year basis. The Fed has never tightened in that environment, and they're focusing on lagging measures like unemployment and inflation. So to me, that's that tilt towards recession that's almost inevitable that has gold fired up. And the key thing is, the key trigger, I think, will be when the U.S. stock market continues to underperform the rest of the world, and gold will be the shining star. The key question we ask ourselves, I ask myself right now, is what stops that trajectory? Typically, it's significant Federal Reserve ease and a decent amount of lag, and they're still tightening.
Okay, so if gold is the boomer metal, then what is the millennial metal? Is it a metal like? Is it lithium? We've heard about all of this focus around some of the other metals that are going to be infused into so many different elements of how chips are created or how it's going to go into automotive practices. All of that considered, what is that new type of metal that people can also be looking into if they're kind of saying, you know what, I'm maxed out in gold?
I know you didn't want that answer, but I have to give you the facts. Millennials don't really care about gold. They focus on Bitcoin. And the key thing about I look at Bitcoin and gold is that relationship is you really can't have some of this old guard gold anymore without some Bitcoin in that space, because Bitcoin is clearly on a trajectory of becoming global digital collateral in a world going that way. Now, it's still a very much risk asset. It's still very new. But the key thing it has, I've never seen in any commodity before, is definable diminishing supply, in early days, low adoption, increasing demand. So to me, in the big picture, that to me is where millennials will look. You look at other metals that maybe potentially have a good upside in the longer term, copper, I would say, but that's more dependent on global economic recovery. In the meantime, we're tilting towards recession. So I look at things like crude oil and copper still heading lower and tilting lower, and OPEC actually might have aggravated that, and gold tilting higher.
The search for safe havens turns to an old friend, gold. Investors taking a closer look at the precious metal as a traditional safe haven asset as bank instability, inflation, and of course rising rates add to the gloom. But is all that glitters good for investors? Here with more, George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. Good to see you, George. We're seeing gold seeing some gains today near the highs of the day at the moment. What do you attribute this to? We know that people have been looking for safe havens. Is this the moment for gold?
I think so, yeah. I think, we live in very, very uncertain times, Rochelle, and they just seem to be getting more uncertain as we go. I'm a little concerned that the markets seem to be losing their faith in Jerome Powell and what he says. Powell, I think, has made it pretty clear that he sees no possibility of a rate cut in 2023, and yet I understand that the markets right now are actually betting on a rate cut as soon as June of this year. That seems to me kind of crazy. I think that's leading to some exuberance in some sectors of the stock market, which I frankly don't think are warranted. And I think that we have a lot more uncertainty coming. And if the markets are starting to lose faith in the people who are controlling interest rates, then I think that things are just going to get worse from here. That means that more people will need more safe havens. Gold will come into its own when that's the situation.
And in terms of how it benefits a portfolio, I mean, you list a couple of things: risk management, capital appreciation, wealth preservation. Break those down for us.
Okay, look, to me, the promise of gold for investors has historically always been of a dual nature. Over time, and I think that's the only way to measure the performance of any portfolio asset, and gold in particular, over time, gold can help to enhance your returns. And over time, gold can help to reduce the volatility of a properly balanced portfolio. In other words, over time, gold can help to enhance your risk-adjusted returns or improve your Sharpe ratio, as the brokers call it. I think that that's really the key from this point of view. While it's doing all those things, it is also, as you say, it's adding diversification. And I think that this is really very important for investors. A small allocation to gold within the context of a properly balanced portfolio has always made sense as a strategic allocation. And I think from time to time, it also makes sense as a tactical allocation. I'm still looking at that one, but the strategic benefits of gold, I think, have been demonstrated many, many times and will continue to be.
I mean, and even with some volatility, gold futures still up 15% over the last 2 years. How would you compare its performance to the S&P 500 when people are trying to decide where to put their money, knowing that perhaps the returns may not be as great, though, if they're going with gold?
Look, I'm not saying that everybody should sell all of their stocks and put all their money into gold. That's absolutely not the way that we look at gold at State Street here. But I do think that a small allocation in a properly balanced portfolio can make sense. The way that I like to look at gold's performance over the 20 years or so of this century, gold opened this century at $255 an ounce. So seeing a price today of $1,965, that's a pretty good gain. That's actually somewhat better than the S&P 500 did over that same period. And I would also make the point, when you talk about volatility over time, gold has shown that it is marginally less volatile than the S&P 500. That really says something important. The S&P 500 is an index, and an index by definition is always going to be less volatile than the individual things that make it up. Gold's just an individual asset, but it has over time been marginally less volatile. It may only be 1 or 2 percentage points, but it's 1 or 2 percentage points in the right direction. If gold can reduce my volatility and has the potential to enhance my returns, then I'm going to want a small allocation to that in my portfolio as a strategic asset.
I mean, and that certainly makes sense. I mean, usually people, flock to bonds, but when you have an interest rate sensitive device like bonds, that's not the safe haven that people look to. So then in terms of perhaps any other sort of risks that do attach to gold, if it's not interest rates, what are some of the risks that people should be aware of, at least keeping mindful of when they're investing in gold?
Well, look, I think, one of the things that can happen and has happened at various points in history, not every time, but on occasion when we've had a sudden drop in the stock market, and I think if we are going to move into recession this year, which is still very much on the cards, then I think that we might well see that sudden drop in the stock market. That means that anybody who's actually bought stocks on margin is going to be faced with calls for increased margin as the value of their holdings has declined. Rather than selling out of those holdings, those investors who are savvy enough to own some gold have in the past been able to sell a little bit of gold in order to meet the margin calls on their depressed equities. But typically what has happened, and this has happened every time we've had one of these big moves down in equities, whether it's 2008, whether it's 2020, we go all the way back to 1987. We've had an awful lot of sudden moves down and gold has benefited. Initially, gold may well go down with equities on this margin call liquidation. But typically, when investors see that gold has done what what exactly they bought it for, then they will re-up their gold holdings as quickly as they can. That has generally been the case. Whenever you've had a sudden downturn in the stock market, stocks have remained depressed for months or even years. Gold typically is recovered within months or even weeks. And I think that's an important thing for investors to bear in mind. So that's one of the risks. But don't be fooled just because on a temporary basis, stocks and gold may go down together. Doesn't necessarily mean that they're correlated. I think that what we've seen in the past is that there's a very different kind of relationship. There's an asymmetrical relationship between gold and stocks. And I think that I would expect gold to get better if, as I expect, stocks will start to weaken.
And certainly an important distinction there when we do see perhaps the prices going down at the same time. George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors, thank you for joining me this morning.
Precious metals in general have rallied as Treasury yields have plunged. We're joined now by GraniteShares founder and CEO Will Rhind to find out how to capitalize on these shifts for this week's ETF report brought to you by Invesco QQQ. And Will, talk to us a little bit about what we've seen with gold, with this chaos that we've been watching in the banking industry. And if it continues, what are we to expect when it comes to this precious metal?
Yeah, I mean, what we're seeing is just a classic crisis of confidence. And when you see a crisis of confidence, but particularly in our financial system and our banking sector, people rush for safe havens. And arguably, there's no more famous safe haven in the world than gold. It's one of the highest quality assets out there with no counterparty or credit risk. So in other words, gold can't go bankrupt, unlike a bank. And that's very appealing at this particular point in time.
And Will, demand for gold has shot up, obviously, in the wake of the two banks that collapsed over the weekend. And I understand, if I understand this correctly, GraniteShares did have some exposure to SVB, to Silicon Valley Bank. What has the last week been like for you? And walk us through the last couple of days and give us an inside look at how stressful that time must have been.
Yeah, no, absolutely. So we used Silicon Valley Bank in the UK where we have a business. In the US, we didn't, but obviously it affected the whole company. So regardless of where you were positioned, and we, like a number of other firms in the sort of venture-backed sort of startup space, used them because they were incredibly friendly to startup companies like us operating in the fintech space. And so when we saw on Thursday the stock price dropping pretty significantly on the exchange here, started to get worried. And then obviously on Friday, it dropped dramatically further. And so we tried to, move money, out of the accounts in the UK. But obviously by that time, and unbeknown to us at the time, the actual bank had frozen up. So fortunately, we weren't holding a huge amount of money at that particular time, so weren't really affected by it. but it's a wake-up call for everybody in terms of the banking relationships that you have and how quickly something like this can happen.
And given with what we've seen with Credit Suisse today as well, and just the banking sector in general, and that concern that investors have had, I mean, in talking to investors as well, what are you expecting as far as what the Fed may do next week? Are you thinking that a rate hike should be definitely off the table here?
I mean, I'm definitely in that camp. I just can't see it. Really, we've got to a position where at 4.75%, you have banks failing. Now, obviously, people will make the argument that that's not exclusively down to the Federal Reserve, and that is down to some specific policies that those institutions took that didn't go right. But I think you just have to look at the broader reaction, from the market to tell you that interest rates have gone up too quickly, too high, and it's causing problems now for the system. My bigger worry is that you see bank runs happening, and people perhaps might forget that we first started seeing bank runs happening in 2007. As early as August in 2007 with Countrywide Financial, and obviously in the UK later on that year in September with Northern Rock, and that was really a year before the financial system completely collapsed with the bankruptcy of Lehman. So I'm starting to worry that this is the beginning of a broader crisis here, and I think the gold market is telling you that, and that's why we're seeing gold prices well above 1,900 today.